everyone, it's Gloria here with Remax Loke, and I'm here with Mike Morisset with Mortgages by Mike. And today Mike and I are going to discuss how you can improve your credit rating.
Yes, well, credit and also debt load.
Yes.
Yeah, we're running into a lot of people that are coming to us now, especially in this market with the higher qualifying rate for mortgages, that debt outside of your mortgage is having a big impact on your ability to qualify. So having even a $10,000 on a line of credit, when it comes to how much we have to debt service on a monthly basis, we have to say a $300 a month payment. And a $300 a month payment is a big obligation when it comes to qualifying. So we're trying to help people a lot these days manage debt better. And the first step is really just stop creating more debt.
Exactly.
Start accumulating. If there's a situation where you're not making the ends meet month to month, if you're bringing in a household income of $10,000 and you're spending 11, then you just need to make a decision to recalibrate, adjust your lifestyle. I had to do that many times in my life. 40 years old, and been 20 years. I probably had to do it 3 or 4 times in my life so far in my working life, where you have to recalibrate what's happening to make sure things are happening. So that's the first thing, is making sure you just stop accumulating more debt. Hard stop on that end of it. The other situation is just sort of repositioning your debt. So if you're sitting there and you have, say say $20,000 on a credit card, and you're paying 19%. Another thing that we can do is take that credit card debt and move it over to a line of credit, and be at something where it's 9%, cutting the interest that you're paying in half, and then being much more thoughtful about how you pay that down.
Right.
So if you're ended up dropping your interest rate or interest, monthly interest by say $200 to $100, make sure you're putting that extra $100 towards the principal and paying it down faster and getting that stage. So there's definitely an opportunity to reposition debts, but to reposition debt just to create more free cash flow or more monthly flow of cash or more debt opportunities, it just digging yourself into a bigger hole.
Would you suggest, when you do have some extra cash, when you are paying everything off, you should put it somewhere in a safety net, right? Just to have that to fall back on? Would you recommend that?
In my opinion, I would pay down debt first.
Okay.
Just because to have a safety net, it doesn't balance out really that well.
Okay.
So if you have a line of credit, obviously, say you have a $10,000 line of credit, you have an extra $5,000, you put it on that.
Okay.
You can always go back to that in worst case scenario, but I think in many cases, pay down the debt, it's basically just peeling off income every month that you're making. When you're paying interest, that interest is going somewhere. It's basically making sure that you're working hard to pay for somebody else's quality of life.
Exactly.
So that's a big thing. And another thing that we run into too with people, especially in the people that starting to be more concerned about their retirement, you sort of may get to the middle age point, or my age, 40 years old, get to a point where it's like, okay, I gotta start thinking about retirement. And people are sitting there with debts of outside of a mortgage or a car payment, but sitting with a $20,000 line of credit or a $20,000 credit card, and they're putting $500 into their RRSP every month because they're concerned about retirement. And it does logically feel like the right decision to make, but really it is not. You need to be putting that $500 towards the debt and paying down debt first, because it doesn't make you paying 19% on a credit card and you're getting 7% on your RRSP. It just doesn't work. So do a hard stop on that and go towards focusing on paying down the debt. Putting money into your retirement savings is useless if you sit in there. You're not going to retire with credit card debts, right? It doesn't work that way. So have to get around that there.
Okay, and starting out with, how many credit cards should you normally have? I mean, I know that we always need to have some type of credit when we're actually thinking about buying a home, or if you are making a purchase, right? I mean, all the banks need to see something. But what would you suggest we start out with?
In most cases, I think people have like sort of a general card that they use that's sort of, one card with, it can be anywhere depending on your lifestyle. I have a credit card for $10,000-ish, and then I use that sort of on a standard basis, and then I also have a line of credit that's sort of there for emergency situations if I run out of cash flow. And then I also have an emergency credit card, so just I happen to go to the gas machine and I can't get fuel, I have a backup card available. Other than that, and a mortgage, I don't really think there's a real need for a lot of debt. And you start accumulating more and more of that, it just doesn't make sense. And I think I'm a big fan of bumper bowling. in life, and I have, you give me more opportunities to make mistakes, and I'll make mistakes. So I like to play in that box and make sure that I live that way. If I spend more than I make, I got to make it up somehow very fast. So it's just being really a lot more disciplined with ourselves, and just because the bank's willing to give you the money doesn't mean you deserve it.
Exactly. Yeah, no, and that's the one thing. I know that banks, they can offer you and they'll give you money and say that you can have this much. It's always good never to take it all, right?
Yeah.
You never want to strap yourself. You want to make sure that you can pay your bills and live day to day and actually enjoy life as well, right?
Absolutely, and it's great to have. Everybody wants to have a high quality of life, but when you're putting it on a credit card to enjoy that, it's just it's a delusion, right? You're not really enjoying your life. You're just hurting yourself in the future or delaying your pain.
Exactly.
So, and when it comes to that sort of topic of things, there are circumstances where people just accumulate way too much debt, and it happens. We find a lot of situations where there's a massive change in life, whether it's separation, divorce, job loss, whatever there is, and those are situations where you cannot see the end of this punishment happening. And we have people that have $70,000, $80,000 in consumer debt, and they just have nowhere to turn. And there's a few different things that they can do, which is there's a debt consolidation services where you go back to the creditors and ask them to go down to 0 interest rates and pay it off that way, or consumer proposal where you negotiate the balances, pay that all down and consolidate it really fast and pay it off for a shorter period of time, or on the extreme doing something like a bankruptcy. The big thing is a lot of people are going to thinking it's a free pass to unload the debt. And reality is not. You have to go through a process. They're going to eliminate all your credit. They're going to ding your credit score is going to be affected for 7 years. You're going to be paying much higher interest rates if you want to buy a home, much higher down payments. So it is a path that there are people that we recommend they have to do it. There's no other choice. But make sure you're not doing it as sort of a path to get away from some minor mistakes you made in life. I wouldn't be doing a bankruptcy over $10,000 in debt.
Right. Yes.
But when it gets to a point where it's just too extreme, then you definitely have to put up your hands and just say, hey, like, too much. And there obviously is a responsibility that you bear as the person that took on the debt, but there's also a responsibility to the creditor who is, bear the responsibility of giving you the debt. So there are points when you need to put up your hands and just say, like, enough's enough, and the suffering is too much.
Exactly. I know debt can be scary, but the best thing to do is head it on and address it right away.
Absolutely, right?
Don't let it just, push it to the side year after year. There's so many people out there that can help you to, get you to a better place. So. And
absolutely, and there's people that want to help you too. Like, it's not like it's just there's people that are out there that have gone through the mistakes that you made. Let them help you. Let them sort of walk you through the path and get you through the other side of this.
So if somebody has decent credit, good credit, or the credit score, like, it always plays a big factor when you're wanting to get a mortgage. So tell us a little bit about that, how it works.
So on the credit score side of things, it's like looking at somebody's balance sheet. It's a really good snapshot of your life without sort of the story behind it of, like, this is why this happened. It's this person has a $10,000 line of credit with $5,000 drawn. This person has a $20,000 credit card with $19,000 drawn, and this person has a line, a $5,000 credit card that's overdrawn. All those different things are looked at, and it gives a snapshot of your score. So if you're in a situation where you have, like, no credit at all, then your credit score doesn't exist. So you need to have a couple different credit facilities, whether it's a credit card, line of credit. That'll help impact your score and give you a score. And then it comes down to how you manage it, how much you've accumulated, how many trade lines do you have, how much credit do you have. Like, you have 2 car payments, 2 maxed out credit cards, a line of credit, a mortgage. Like, they're going to look at those things, and that's going to generate a score. So the more debt you have available, and then the more you draw, will change your credit score.
Right, and that credit score definitely impacts you getting
Absolutely.
a mortgage, right?
It's a huge impact, and bigger impact than ever before.
And how does that impact on basically what you can mortgage? And
well, it does. There's 2 factors on it. Like, obviously the credit score generates a score that tells the lender, like, what's the liability here of this client, what's the risk there, and if the score is just too low, then they're just going to put their hands up and walk away, and they're not interested at all in generating in the score. There's a certain area which is around 650, which is a sort of a little bit below average credit score. And then there have some lenders that are, no, we want to have a 700 credit score for the applicant if we want this mortgage, and you get a little bit better rate for having a higher credit. If you start going down lower and lower and lower, you're going to get it to a point where you're going to pay a stream premium to get a mortgage because of your credit. So it's something you want to take into consideration on that factor. And then there's situations too where if we're finding it more with single income earners. If you sit there and have a $10,000 credit card or a line of credit, we have to debt service a monthly payment on that of $300.
Oh, wow, okay.
So if you sit there and do that, it doesn't seem like a lot, but if you have like a $300 credit card debt servicing payment, and then you have a $500 car payment, and you start doing it, it really chips away in this market with the qualifying rate of how people have to qualify. It really chips away at people's qualifying and what they actually can qualify for. So we have people that are making like household incomes of $110,000, $120,000 a year, but they have 2 car payments of $600 each, and they can't qualify for a $500,000 home. And it's based on the fact of like there's a huge obligations there you have on a month-to-month basis. So in this market, it's very important that you take that into consideration. And even though you are able to make the monthly payments and you're managing your debt well and all these different things, that is only a small factor in the overall picture. But we still need to make sure that you fall under the guidelines and that your monthly payments are under the certain factors that the government wants us to take into consideration.
And another thing too is when you're getting ready and you're thinking that you want to look at buying a home, don't go ahead and get a car loan.
Yes, absolutely.
Like you don't want to add more stuff to your...
Step one, do not take on more debt before you want to buy a home at all.
Yes,
it's
exactly.
It's a big factor, and it's even if you're thinking now, if you're saying in 2019 I want to buy a house, end of 2019, I would start planning now, going through the process, getting pre-approved, getting checking the credit, seeing if there's any debts we can pay down. All those things can happen, and it has a big factor on how we can, how smooth we can make the process. So I definitely think as a consumer looking to, purchase a home or refinance, it's much more of a process than ever before, and much more technically challenging for the consumer. So I think it's definitely you need to reach out and figure out what you need to do on your end of it to make it so that you can optimize obviously the end result, but also the rates and all the impact on those things. So.
Well, that's a lot of great information, and hopefully everybody, that you guys have taken something home with you and learned a lot here from Mike. And again, if you guys have any questions, I'll post up our telephone numbers and our emails, and you guys can contact us anytime. Okay, have a great day.
Thank you.